The dance of volatility, it beckons with promises of swift returns, a siren song for those who believe they can tame the market's wild heart. It's a world where numbers flicker and fortunes seem to materialize from thin air. But beneath the surface of sophisticated strategies and complex models lies a truth often overlooked. Volatility trading is not a shortcut to riches. It demands the same rigor, the same discipline, the same unwavering focus on value that Benjamin Graham championed. Investment is most intelligent when it is most businesslike. Graham's words echo through the decades, a timeless reminder that speculation is a dangerous game, especially when dealing with something as elusive as volatility. To approach it with anything less than a businesslike mindset is to invite disaster. It's a sentiment Warren Buffett would surely endorse. So, why are so many drawn to the illusion of easy profit in volatility trading? Perhaps it's the allure of complexity, the belief that mastering intricate formulas equates to mastering the market itself. Or maybe it's the seductive nature of leverage, the promise of amplified gains that blinds investors to the amplified risks. But here's the truth. Volatility trading, when approached without a critical eye, is a minefield of hidden mistakes. These aren't obvious blunders, the kind that novice traders quickly learn to avoid. These are subtle traps concealed beneath layers of sophisticated analysis, capable of derailing even the most experienced practitioners. In this video, we're not interested in surface-level observations. We're diving deep, unmasking the illusions that cloud judgment and lead to costly errors. We're not here to offer a get-rich-quick scheme or a foolproof strategy. Instead, we are uncovering the hidden truths behind wealth accumulation. We're here to equip you with a critical investor's perspective, a Graham-inspired approach that prioritizes value, risk management, and a healthy dose of skepticism. Over the next few minutes, we will reveal 5 hidden mistakes that can sabotage your volatility trading efforts. These are not theoretical concepts, but practical lessons gleaned from the real-world experiences of traders who have navigated the treacherous waters of the volatility market. Don't just invest, understand the why behind every decision. Challenge the consensus. Find your edge. Are you ready to dismantle the myths and embrace the reality of volatility trading? The promise of a perfect prediction, a glimpse into the future of market turbulence. It's a powerful law. And in the world of volatility trading, that promise often comes in the form of sophisticated algorithms, complex models touted as the key to unlocking consistent profits. But what happens when these black boxes fail? What happens when the carefully crafted code crumbles under the weight of unexpected market events? Flash crash, geopolitical shocks, unforeseen economic shifts. History is littered with examples of algorithmic models failing spectacularly. These aren't mere glitches. They're stark reminders that algorithms, no matter how sophisticated, are not infallible. They are built on historical data, trained to recognize patterns from the past. But the future, as we all know, rarely repeats itself perfectly. The fallacy lies in believing that an algorithm can anticipate every possible scenario, that it can account for the unpredictable nature of human behavior and the butterfly effect of global events. It's a dangerous illusion, one that can lead to complacency and a false sense of security. Think of an algorithm as a finely tuned instrument. It can produce beautiful music, but only if played by a skilled musician. The programmer is the musician. The data is the sheet music. If the musician is unskilled or the sheet music is flawed, the resulting music will be discordant, even disastrous. Therefore, never blindly trust any volatility model, no matter how impressive its track record. Always understand its underlying assumptions, its limitations, its potential blind spots. Stress test it against extreme scenarios, challenge its predictions, and never ever treat it as a magical oracle. An algorithm is a tool, not a savior. Apply critical thinking and independent validation. Only then can you hope to navigate the complexities of volatility trading with a modicum of safety. Is your understanding of the model as deep as your trust in its output? Imagine a serene lake, its surface reflecting a perfect image of the surrounding landscape. Now, picture that same lake distorted by unseen currents, its reflection warped and twisted. This, in essence, is the volatility smile. It's a distortion in the options market that can lead even seasoned traders astray. The volatility smile, or skew, reveals that implied volatility is not uniform across all strike prices for options with the same expiration date. Typically, out-of-the-money OTM puts and in-the-money ITM calls have higher implied volatilities than at-the-money options. Why does this matter? Because relying solely on implied volatility can lead to mispricing options, systematically overpaying for OTM options and underpricing ITM options. The core assumption shattered here is that implied volatility reflects a uniform probability distribution of price movements. The volatility smile tells us that the market anticipates a higher probability of extreme price movements, particularly to the downside. Ignoring this skew is akin to navigating a ship without accounting for the prevailing winds and currents. So, how do you navigate this distorted landscape? Incorporate the volatility Smile into your option pricing models. Don't rely solely on a single implied volatility number. Explore models that account for skewness and kurtosis, that capture the nuances of the volatility surface. The Volatility Smile is like a funhouse mirror, distorting the true picture of risk. Don't be fooled by the reflection. Understand the underlying forces that create this distortion and adjust your trading strategies accordingly. Are you seeing the market as it truly is, or are you being misled by the smile? The market whispers sweet nothings. Volatility lulls you into a false sense of security, and the allure of amplified returns becomes irresistible. This is the leverage trap, a siren song that has lured many a seasoned trader to their financial demise. It's the temptation to overextend positions when volatility is low, believing that the calm will last forever. Low volatility can be intoxicating. It creates a perception of reduced risk, encouraging traders to increase leverage in pursuit of greater profits. But this is a mirage. Beneath the tranquil surface, systemic risks can be building, waiting for the opportune moment to erupt. Consider the cautionary tale of Long-Term Capital Management (LTC). This hedge fund, populated by Nobel laureates, employed sophisticated arbitrage strategies, seemingly exploiting low-risk opportunities. But their excessive leverage proved to be their undoing. When unexpected events shook the market, their positions imploded, threatening to destabilize the entire financial system. Low volatility can mask underlying systemic risks and create a false sense of security. It's like walking on thin ice, unaware of the frigid water lurking beneath. As Warren Buffett wisely advises, be fearful when others are greedy and greedy when others are fearful. Apply this to volatility. Be cautious when volatility is unusually low and others are complacent. The solution: implement strict position sizing and risk management rules. Use volatility-adjusted position sizing, adjusting your position size based on indicators like the VIX. Remember, the market's memory is long, and periods of low volatility are inevitably followed by periods of high volatility. Are you prepared for the inevitable shift? Volatility is a force, a tempestuous energy that can create both opportunity and destruction. But it is not an island. It's inextricably linked to the direction of the market. To believe that volatility trading is directionally neutral is a dangerous misconception, a mirage that can lead to significant losses. Many traders fall into the trap of thinking they can profit from volatility regardless of whether the market goes up or down. But the reality is that most volatility strategies have inherent directional biases. Short volatility strategies, such as selling options, can be profitable in stable markets, generating consistent income as options expire worthless. However, they can be utterly disastrous in sudden downturns, exposing traders to unlimited losses. Conversely, long volatility strategies, such as buying options, benefit from sharp market declines. They act as insurance, protecting portfolios from catastrophic losses, but they can also be costly to maintain in stable markets, as the premium paid for the options erodes over time. The cognitive factor at play here is overconfidence bias, the tendency to overestimate one's ability to predict the future. This bias can hinder the ability to critically analyze the directional exposure of a volatility strategy, leading to a false sense of security. Therefore, analyze the directional exposure of your volatility strategies under different market scenarios. Use stress tests and scenario analysis to understand how your positions will perform in various market environments. Trading volatility without a market thesis is like sailing without a compass. You might get lucky, but you're likely to get lost. Do you know where your volatility strategy is headed? The world unfolds with a gentle predictability, a comfortable illusion that lulls us into a sense of security until the unexpected strikes, a black swan event that shatters the facade of normalcy and leaves devastation in its wake. This is the realm of tail risk, the risk of extreme, low probability events that can have a catastrophic impact on portfolios. Traditional risk models often underestimate tail risk, assuming that market returns follow a normal distribution. This is a dangerous simplification. In reality, market returns exhibit fat tails, meaning that extreme events occur more frequently than predicted by a normal distribution. Ignoring tail risk is like building a house on a fault line, oblivious to the potential for a devastating earthquake. It's a gamble that can wipe out years of accumulated wealth in a matter of days, even hours. As Benjamin Graham wisely stated, the essence of investment management is the management of risks, not the management of returns. Apply this to tail risk. Focus on protecting against catastrophic losses, not just maximizing potential gains. Incorporate tail risk measures, such as value at risk, VAR, and expected shortfall into your risk management framework. Consider using option strategies to hedge against extreme market moves. Remember, black swans are inevitable. It's not a question of if they will occur, but when. Are you prepared to weather the storm? We've journeyed through the intricate landscape of volatility trading, unearthing hidden pitfalls that can derail even the most seasoned investors. We've explored the allure of algorithmic models and the dangers dangers of blindly trusting their predictions. We've navigated the distorted reflections of the volatility smile, and we've confronted the siren song of leverage in low volatility environments. We've dissected the directional biases inherent in volatility strategies, and we've peered into the abyss of tail risk, acknowledging the potential for extreme market events. These 5 hidden mistakes: algorithmic over-reliance, ignoring the volatility smile, leverage traps, confusing volatility with direction, and ignoring tail risk, represent critical lessons for anyone seeking to master the art of volatility trading. But knowledge alone is not enough. It must be coupled with rigorous analysis, disciplined risk management, and, above all, a critical mindset. Volatility trading is not a get-rich-quick scheme. It's a complex endeavor that demands a deep understanding of market dynamics, a keen awareness of behavioral biases, and an unwavering commitment to protecting capital. As Warren Buffett wisely stated, risk comes from not knowing what you're doing. Apply this to volatility trading. Thoroughly understand the risks involved before deploying capital. Embrace a Graham-inspired approach, prioritizing value, margin of safety, and a healthy dose of skepticism. Challenge conventional wisdom, question assumptions, and never be afraid to admit what you don't know. The path to volatility trading mastery is not paved with easy profits. It's a journey of continuous learning, adaptation, and refinement. Apply the lessons learned here to your own investment strategies and continue your quest for financial mastery. Remember, the market rewards those who are prepared, disciplined, and intellectually honest. So, as you navigate the ever-changing landscape of volatility, ask yourself, are you truly prepared to embrace the risks, or are you simply chasing the illusion of easy profit? The answer, my friends, lies within your own critical analysis, your own disciplined approach, and your own unwavering commitment to understanding what you're doing. What steps will you take today to transform your understanding of risk in the pursuit of sustainable wealth?